What if I told you that in March of 1998, 9 of the most powerful men in America met in a wood-paneled conference room in Lower Manhattan and signed an agreement that would quietly reshape the entire American financial system? No press conference, no congressional hearing, just signatures, handshakes, and a gentleman's agreement that your savings, your mortgage, and your retirement would become chips in the largest casino ever built. You feel it, don't you? That gnawing sense that no matter how hard you work, the rules are written for someone else. That inflation eats your paycheck faster than you can earn it. That every financial crisis somehow makes the rich richer while you are told to tighten your belt. That's not paranoia. That's the system working exactly as designed. This isn't a theory, it's documented. And the financial weapon they unleashed that day, over-the-counter derivatives and the shadow banking system, is now a $700 trillion time bomb sitting underneath the global economy. Before we go further, drop a comment and tell me where you're watching from. This community is built on people who refuse the sanitized version of history. And if you want the unfiltered truth about how money, power, and deception actually work, hit that subscribe button. You're going to need it for what comes next. Because what they signed wasn't just a financial agreement. It was a pact to make sure you would never understand who was really in control. Let's rewind. 1998. The Cold War is over. The internet boom is roaring. America is the undisputed financial superpower. Alan Greenspan is Fed chairman, hailed as the maestro who tamed inflation and delivered prosperity. Wall Street is printing money. Everything looks perfect. But behind the scenes, a fight is brewing. Brooksley Born, the head of the Commodity Futures Trading Commission, has noticed something disturbing. Banks are trading exotic financial instruments called derivatives, contracts whose value is derived from other assets, in massive, unregulated private markets. We're talking trillions of dollars changing hands with zero oversight, zero transparency, and zero protection for the public if it all goes wrong. Born wants to regulate this market. She wants sunlight. She wants rules. Sound familiar? Every time someone tries to shine a light on Wall Street's darkest corners, they get the same treatment. So Greenspan calls a meeting. He brings Treasury Secretary Robert Rubin, former co-chairman of Goldman Sachs. He brings Deputy Treasury Secretary Larry Summers, a Harvard economist who believes markets regulate themselves. He brings Securities and Exchange Commission Chairman Arthur Levitt. And he brings Born into a room and tells her, in no uncertain terms, to back off. The derivatives market, they insist, is too complex, too important, and too profitable to regulate. Regulation, they argue, would stifle innovation and push business overseas. Born refuses. She issues a concept release, a public document asking whether derivatives should be regulated. Wall Street panics. Within weeks, Greenspan, Rubin, and Levitt issue a joint statement, a nearly unprecedented move, condemning her proposal. Congress, flooded with Wall Street cash, passes legislation stripping her agency of authority over derivatives. Born resigns in 1999. Sound familiar? A regulator tries to protect the public. Wall Street flexes. Washington folds. The public loses. But here's where it gets darker. That meeting, that agreement to keep derivatives unregulated, wasn't just about protecting profits. It was about building a parallel financial system, a shadow banking network where the normal rules, capital requirements, transparency, accountability, didn't apply. Banks could gamble with unlimited leverage. They could hide risks off their balance sheets. They could create synthetic assets, financial ghosts that existed only on paper but could destroy real companies, real pensions, real lives when they collapsed. And collapse they did. 2008, Lehman Brothers, Bear Stearns, AIG, Countrywide. The entire global financial system seized up because of the exact unregulated derivatives market Born warned about a decade earlier. Credit default swaps, collateralized debt obligations, synthetic CDOs, all the jargon-heavy weapons of mass financial destruction that Wall Street built in the shadows. The bailout? $700 billion from taxpayers. But the real number, when you include Federal Reserve emergency lending and guarantees, was over $16 trillion. 16 trillion. That's more than the entire U.S. economy at the time. And who paid? You did. In lost jobs, foreclosed homes, vaporized retirement accounts, and a decade of stagnant wages. Sound familiar? Crisis, bailout, profit, repeat. Here's the part they don't teach in economics class. That 1998 agreement wasn't an accident. It was a choice. A deliberate, calculated decision by the most powerful financial minds in America to prioritize Wall Street profits over public safety. They knew the risks. Born spelled them out, but they signed off anyway because the system, the real system, isn't designed to protect you. It's designed to extract from you. And the craziest part, it's still happening right now. Today, the derivatives market isn't smaller after 2008. It's bigger, way bigger. The Bank for International Settlements estimates the notional value of outstanding derivatives at over $600 trillion as of 2023. That's 7 times global GDP. It's a financial weapon so large, so interconnected, that no government, no central bank, no institution can fully understand or control it. Sound familiar? But here's the twist you didn't see coming. That 1998 meeting? It wasn't just about derivatives. It was about control. Because when you create a financial system so complex that only a handful of people understand it, you don't just make money, you make yourself indispensable. Think about it. After 2008, how many bankers went to jail? One mid-level Credit Suisse trader. Not the CEOs. Not the architects of the fraud. Not the men who knowingly sold toxic mortgages as AAA-rated investments. Why? Because the system they built made them too big to fail and too powerful to prosecute. And who benefited? The same people in that room. Robert Rubin went on to make over $126 million at Citigroup, the bank that required the largest bailout in history. Larry Summers collected millions in speaking fees from Wall Street firms while advising the Obama administration on financial reform. Alan Greenspan retired to a lucrative consulting career, his reputation as the maestro somehow intact despite orchestrating the largest financial disaster since the Great Depression. The agreement they signed wasn't written on paper. It was a philosophical pact. A mutual understanding that Wall Street and Washington would protect each other, no matter the cost to everyone else. Regulatory capture isn't a bug, it's the feature. But there's one name, one document, one smoking gun that proves this goes even deeper than you think. A legal framework passed just 1 year after that meeting, in 1999, that permanently cemented Wall Street's control over the government. You won't believe the name. And the receipt? It's wilder than you think. Let's talk about how this actually works. Because the real conspiracy isn't hidden. It's hiding in plain sight, buried under jargon designed to make you feel stupid for asking questions. First, the mechanism. Over-the-counter derivatives are essentially private bets between financial institutions. Unlike stocks or bonds traded on public exchanges with clear prices and regulations, OTC derivatives are negotiated in private. You want to bet that a company's stock will crash? Create a credit default swap. You want to bet on the direction of interest rates? Create an interest rate swap. You want to bet on bets? Create a synthetic collateralized debt obligation. Here's the key. These contracts are bilateral, meaning only the two parties involved know the terms. No regulator, no exchange, no public record. This creates systemic risk, because no one knows how interconnected the system really is until it's too late. When Lehman Brothers collapsed in 2008, it had over $900 billion in derivatives contracts. Nobody knew who was on the other side of those bets until the dominoes started falling. This is financial contagion by design. And it gets worse. The shadow banking system operates alongside traditional banks, but without the same rules. Hedge funds, private equity firms, investment banks, and special purpose vehicles can borrow unlimited amounts, use extreme leverage, and hide liabilities off their balance sheets. In 2007, the shadow banking system held over $20 trillion in assets, nearly equal to the traditional banking system. But it had none of the safeguards. No deposit insurance, no capital requirements, no lender of last resort. When the music stopped, these institutions couldn't meet their obligations. Money market funds, supposedly safe investments for retirees, started breaking the buck, losing value. Repo markets, the overnight lending system that keeps Wall Street liquid, froze. AIG, the insurance giant, needed $182 billion in bailouts because it had sold credit default swaps, essentially insurance against mortgage defaults, without enough capital to pay claims. This wasn't stupidity, it was greed weaponized by deregulation, and the numbers prove it. In 1998, the year of that secret meeting, U.S. commercial banks held $633 billion in derivatives. By 2008, that number exploded to $182 trillion. That's a 28,000% increase in a decade, and it wasn't spread across hundreds of institutions. 5 banks, J.P. Morgan Chase, Bank of America, Citigroup, Goldman Sachs, and Wells Fargo, controlled 96% of it. 5 banks, 96%. That's not a market, that's an oligopoly. Now, let's talk about the smoking gun. The Gramm-Leach-Bliley Act, passed in November 1999, just 18 months after that meeting. This law repealed the Glass-Steagall Act, the Depression-era regulation that separated commercial banking from investment banking. Why did that matter? Because it allowed banks to gamble with your deposits. Before Gramm-Leach-Bliley, your savings account was protected. Banks couldn't use your money to make risky bets. After Gramm-Leach-Bliley, they could merge commercial banking, investment banking, and insurance into one mega institution. Citigroup, the first megabank, was created literally 1 year before the law passed through a technically illegal merger. The law was retroactively changed to accommodate it. Think about that. They broke the law, then changed the law to make it legal. Sound familiar? The architect of this law? Senator Phil Gramm, who received over $2.5 million in campaign contributions from the financial sector. After leaving Congress, he became vice chairman of UBS, one of the largest investment banks in the world. His wife, Wendy Gramm, served on the board of Enron and chaired the Commodity Futures Trading Commission before Born, where she helped exempt derivatives from regulation. This is the revolving door in action. Write the laws, profit from the laws, repeat. But the real moral hazard came next. After 2008, instead of breaking up the banks or jailing the architects of fraud, the government made them bigger. J.P. Morgan Chase absorbed Bear Stearns and Washington Mutual. Bank of America absorbed Merrill Lynch and Countrywide. Wells Fargo absorbed Wachovia. The 5 largest banks controlled 44% of U.S. banking assets in 2007. By 2015, they controlled 47%. Too big to fail became bigger and more fail-prone. And the derivatives market? It didn't shrink, it metastasized. By 2023, the notional value of global derivatives reached $610 trillion, according to the Bank for International Settlements. To put that in perspective, global GDP is around $100 trillion. The derivatives market is 6 times larger than the entire world economy. This is not a market. It's a Ponzi scheme with better branding. Here's where it gets philosophical. The system isn't broken. It's functioning exactly as intended. Financial crises aren't accidents. They're features. Every crash transfers wealth upward. Every bailout privatizes profits and socializes losses. Every recovery benefits asset holders, the top 10%, while everyone else drowns in debt. The 1998 agreement wasn't about derivatives. It was about establishing a permanent state of moral hazard, where Wall Street could take infinite risks knowing Washington would cover the losses. It's parasitic finance, a system that extracts wealth from the real economy, from workers, small businesses, families, and funnels it to financial elites. And they convinced you it's too complex to understand. That's the genius. Wrap theft in jargon, call it innovation, and shame anyone who questions it as economically illiterate. But you're not illiterate. You're being lied to. So where does that leave us? Staring down the barrel of the same gun, except this time it's loaded with more bullets. The next crisis won't look like 2008. It'll be faster, more global, and more devastating. Why? Because the system is more interconnected, more leveraged, and more fragile than ever. Central banks have kept interest rates artificially low for over a decade, inflating asset bubbles in stocks, real estate, and crypto. Corporate debt is at record highs. Student loan debt exceeds $1.7 trillion. Consumer debt tops $17 trillion. And those $600 trillion in derivatives? Still ticking. When it blows, and it will, there won't be enough money to bail anyone out. The Federal Reserve's balance sheet is already bloated. Government debt exceeds $34 trillion. There's no more ammunition, just promises, printed money, and the hope that confidence doesn't collapse. But confidence is the only thing holding this illusion together. The moment people stop believing, the moment they realize the emperor has no clothes, the entire system implodes. That's the final lesson of the 1998 agreement. It wasn't just about deregulation, it was about denial. Denying risk, denying accountability, denying reality. And we've been living in that denial ever since. The men in that room believed they were smarter than history. They believed financial engineering could replace fundamentals. They believed they could control chaos. They were wrong, and we're about to pay for their arrogance again. But here's the thing. Denial only works if you participate. If you keep your money in their system, play by their rules, and trust their institutions, you're complicit in your own exploitation. I'm not saying burn it all down. I'm saying understand the game so you can stop being the mark. So here's my final question for you. Are we wiser now? Or are we just walking the same path in better suits? Drop your answer in the comments. Share this video with someone who still thinks the system works. And if you want to keep peeling back the layers of how power and money really operate, subscribe. Because the next video goes even deeper into the names, the numbers, and the receipts they don't want you to see. The agreement was signed. The game is rigged. But knowledge? That's the only weapon they can't regulate away.